Over the course of the next 10 years, I'm a precious metals bull. I think the arithmetic of America, the on-balance sheet debts, and in particular, the $120 trillion in net present value of entitlement liabilities means that the purchasing power of the US dollar declines substantially. I believe, in fact, that the US dollar over the next 10 years will lose 75% of its purchasing power. That has profound implications for people who live on fixed incomes, as an example. And it also has profound implications for gold and silver. I think they'll maintain their purchasing power, which means that their nominal price appreciation should match in some way, shape, or form the deterioration in purchasing power of the US dollar. That said, gold gave me too much too fast. I believe that the move that we enjoyed in 2024, 2025 was a coiled spring move, which is to say that the set of circumstances was present in 2020, the same set of circumstances as 2024, but nobody paid attention. So the incredible moves that we've gotten recently, I would liken to a coiled spring, releasing the tension from a market that needed to move. That tension's been released. So we don't have to have the same kind of price moves in 2026 that we enjoyed in 2025. The difficulty is that the move that we enjoyed in 24 and 25 have put in place a narrative. And I think people who adhere to that narrative are going to be disappointed and probably sell in frustration in 2026. And as a consequence of that, miss out on what I think will be a very solid move for the next decade. Past is prologue here, Jack. I'm old enough to remember well the decade of the 70s. In the decade of the 70s, the US dollar lost 75% of its purchasing power, according to the Congressional Budget Office. Not coincidentally, over the period of the decade of the 70s, the gold price ran from $35 an ounce, admittedly price controlled, to $850 an ounce. And the silver price ran from $1.50 to $50. Past is prologue, probably not to the same dimension, the same extent, but past is prologue. The decade of the 70s was very hard for people on fixed incomes. It obliterated long bond portfolios. It was very good for people who were invested in investment instruments where their price or purchasing power kept pace with inflation. Gold and silver, by the way, is not the only way to do that. If you remember back to the decade of the 70s, or more specifically to the period 1968 to 1982, we had an equities market that went at best sideways, mostly down. And yet some securities, particularly those owned by Warren Buffett, companies that had purchasing power, generated for Warren Buffett over 14 years, a 23 or 24% compound internal rate of return. So it isn't as though gold and silver are the only ways to protect yourself from the deterioration in purchasing power. They are, however, the only simple ways to protect your purchasing power. And as a consequence of that, I'm an adherent. What you find in natural resources is that the timeframes that you have to commit to are fairly long. You may not know, Jack, but at Rule Investment Media, I have for free graded almost 100,000 portfolios in 35 years. Looking at 100,000 portfolios has taught me a lot about the way people invest and the mistakes they make. The mistakes are broadly as follows. Most people, if they understand a narrative, don't invest in the narrative until the price action of the commodity that's talked about in the narrative already performs, which is to say nobody wanted to buy silver at $20 an ounce, and everybody wanted to buy it at $60 an ounce. This is just flat stupid, but it's the way that people are. Further, in commodities broadly, capital-intensive cyclical businesses, you are either a contrarian or you're going to be a victim. Those are your two choices. The markets work. The cure for high prices is always high prices, and the cure for low prices is always low prices. The second thing is that investors are unnerved by volatility. There are price moves in commodities and equities. In the junior equities, 15% price moves are commonplace. Really, they just represent the market inhaling and exhaling, nothing more. But people are unnerved about that. I suspect they're unnerved because they don't have an opinion as to the value of the security they own. And as a consequence, they react to prices. If you can't handle volatility, you need to be a very, very, very circumspect investor. The third thing is that most investors don't do enough work. Most investors, money is made in investing on the delta between price and value. Price information is easy to get, but it has no utility if you don't have an opinion as to value. Most people haven't done the work around valuations, and as a consequence, they pay slavish attention to price, which is a huge mistake. And further to that, most narratives take longer to work out than people hope. Many investors are good strategically. They invest in copper because they think over 10 years the copper price will do well due to shortages. That's a 10-year thesis. And if you have a 10-year thesis, but you have trauma holding stock over a long weekend, the juxtaposition between the time required for the narrative to come true and the time you allow yourself to make money is seriously mismatched. And I think investors who are considering any capital intensive cyclical business, not merely commodities, not merely gold and silver, need to review that list and need to take stock of their own adherence to what they need to do to make money investing.
So people should have long time horizons. I wonder what causes the prices of metals to go up or down because I could, for example, in the case of gold, people say gold is rising because foreign central banks are buying. Sure, but they've been doing that for 10 to 15 years. And the huge surge in gold prices didn't happen until the past 18 months. Likewise in silver, there's a shortage, yes, but shortage has been happening for 5 years. And I know in copper, people are forecasting this shortage that I'm sure is eventually going to happen. But price of copper has done well, for sure. But there doesn't, I don't think, it's not a huge shortage in the current numbers. So, what actually causes the bull market to start? Because these narratives, the premise can be true for a long time without you seeing it in the price, and likewise, the price can continue going up long after the premise is no longer been true.
The last part's important. Markets overshoot to the upside and the downside. Given that the market participants are naive, given that they pay attention to narrative, not fact, markets tend to overshoot to the upside and they tend to overshoot to the downside. Don't be looking for the markets to get to equilibrium. That doesn't happen. A reversion to mean doesn't happen. An overshoot always happens. The mean is established by overshooting and undershooting over time. In terms of, as an example, the market's response, because markets in the near term aren't rational, it's important to note in the near term, markets are not, to quote Warren Buffett, weighing machines. They're voting machines. They're beauty contests. They're always, at any one point in time, wrong. A bear market generates a lot of supply, and it takes a while for the changing in narrative to allow the buyers to absorb that excess supply. The circumstance that was in front of us in 2025 that caused the gold price to move was there in 2018. But in 2018, people were informed by the prior 40 years market, which is very benign. So they ignored all of the warning signs. It took 5 or 6 years for people to react to the narrative enough that gold began to get momentum. When gold got momentum, the price action in gold as a consequence of the momentum verified the narrative for the people who paid attention to it but wouldn't accord value to it until, ironically, the price went up. It has never ceased to amuse me that I can pound the pulpit all day long to get people to buy silver at $20 an ounce, and they don't do it till silver is at 60. When the price of silver is up two or threefold and I sell some, the same people who refuse to buy it at 20 call me an idiot for selling it at 75. It's precisely that idiocy, which is to say buying low and selling high, that has been responsible for whatever success I've enjoyed. While I feel sorry for people whose technique is the opposite, buying high and selling low, I need to acknowledge the contribution that those people have made to my net worth.
You were public that you sold roughly 80% of your silver in mid to late January, and you, with some of those proceeds, put it into silver miners. I've looked at price, and silver miners have actually outperformed the precious metal silver commodity since then. What motivated that call? And tell us about your philosophy for expressing a bullish view or bearish view on commodities in miners versus maybe royalty companies versus the underlying commodity, and how that view may be change depending on where you are in the bull bear cycle.
In discussions like this, view commodities as subjects. With my own money, I view them very differently. They have a place in my own portfolio. And I think people need to do that themselves. They need to think about these things not in abstract, but rather as to how they impact their family's fortune. I own gold as a savings asset. I have, in fact, denominated my life in gold since the year 2000. I maintain liquidity in the US dollar, but I save in gold. And my gold is not for the foreseeable future for sale. Silver was a very different asset class for me. Silver was a speculative asset class. And I bought silver because it was hated. I bought silver at $20 an ounce because I theorized that when the hatred around silver dissipated, that the silver price would move. I noted too in 3 prior precious metals bull markets in my life that precious metals bull markets are led by gold. They're led by the fear buyer. And when the momentum in the gold price attracts generalist investors into the precious metal space, leadership, price leadership changes from gold to silver. I thought that would occur. The consequence of that is that I made myself a mental note that I needed to begin to look at silver when silver crossed $50. The idea being that that would be a marker that the hatred about silver had disappeared. When the reason that I own silver disappeared, the silver had to disappear too, unless I could think of some other thesis for keeping it. When I decided that I would sell my silver because its utility to my portfolio was gone, then I needed to do decide what I would do with the proceeds. And what I convinced myself of fairly easily was that if silver maintained its $75 price for 12 months, by definition, I wouldn't make any more money on silver, right? If it just maintained for 12 months, I'd make no money. But if silver maintained its value of $75 for 12 months, the silver stocks, whose net present value was calculated using a $40 or $45 silver price, could increase by 50%. So from a speculative point of view, I had my choice between an investment that might break even versus one that would go up 50%. And ironically, a situation where if the price of the commodity was to decline from $75 to $50 would have no impact on the underlying value of the silver stocks. Maybe in price it would, but not value. So I allocated about half the money that I received after tax. The taxes sadly were substantial on my silver portfolio into the silver stocks. Thus far, the silver stocks, with one exception, have done well. And silver has, as I suspected it might, traded after volatility sideways.